the dollar moving up the way it's moving up is more of a sign of the stress in the global financial system and economic systems. And at some point that stress is going to cause something to collapse.
Here at Liberty and Finance, we're licensed brokers with Miles Franklin. We are standing by the inventory, ready to make sure you get what you need, even into the wee hours of night and on weekends, because preparedness doesn't stop. Call us 1-888-81-LIBERTY. That's 1-888-815-4237.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is David Kranzler from Investment Research Dynamics. David, thank you so much for joining us today.
Elijah, thanks for having me on again. Good to see you.
It's good to see you too. And a lot has changed since the last time we had you on. Well, the last time we had you on, the war was breaking out between Russia and Ukraine, and the U.S. was imposing sanctions. Now, you had mentioned how the sanctions would backfire, and it seems like that's what we're seeing right now as it seems like talking more about possibly backing their currency with gold or connecting it in some way to gold and commodities. And also the ruble has rallied quite a bit since the last time we've talked. It's actually been the best performing currency in 2022. So your take on how the sanctions appear to be backfiring.
I mean, everyone's aware of what's going on with the energy situation in Russia. And I mean, I don't know to what extent the U.S. game planned for this and game planned how it would work out. To me, it's kind of obvious that Putin and his advisors and strategists have been game planning this for a while and have, I think they anticipated a lot of what the U.S. has thrown at them. I mean, Russia is basically holding all the aces, right? I think they're either the largest or second largest energy exporter in the world now. And most of the EU countries are, to some degree or to a large degree, like Germany, are dependent on sourcing oil and natural gas, et cetera, from Russia. And I mean, the difference between the type of sanctions that the U.S. was imposing, financial sanctions, seizing Russian central bank assets that were being custodied in Western central banks, which, by the way, is illegal. I mean, there are property rights, and the law extends. There's a global property rights laws. So, I mean, what the U.S. did was illegal, but that's neither here nor there, I guess, if you want to say in the time of war. But I mean, oil and energy basically has infinite demand inelasticity, meaning that people, the users of it, will pay whatever it takes to get it. It's like food, right? Food has infinite demand inelasticity. If you don't have food, you starve. Well, the way all these countries, the way the industrial world's set up, whether or not you're an ESG guy or, alternative energy guy, the infrastructures aren't set up to support alternative energies. And regardless of what your view is on the environment or whatever, I mean, oil is still on a cost per BTU basis by far the cheapest source of energy around. And until that changes, oil is going to be the use of fuel. So, I mean, I think it's pretty obvious how that aspect of the sanctions are backfiring. The U.S. I have read some things that there's, I guess, a lot of shipping companies won't deliver into Russian ports now. So I don't know. I mean, we don't know. No one knows. And we're not getting the right information from the Western media. We don't know what it looks like on the ground in Russia in terms of, like in this country, there's a baby formula shortage. We don't know if there's shortages of non-discretionary consumption items for the Russian population. Who knows? But in terms of the financial sanctions, I mean, I think I'm pretty sure Russia and China had already had alternative measures to replace the SWIFT system in place that were operable, anticipating that something like this was going to eventually happen, not necessarily over Ukraine, but over whatever, South China Sea, whatever. And also, I mean, the really brilliant move from Russia's standpoint, and I'm not saying I'm taking Russia's side in this, but was throwing out there the possibility of backing the ruble with gold and with oil, and it's, in certain ways that's already kind of occurring, and I think that's why we've seen such a massive rally in the ruble. So, I mean, from my standpoint, and I didn't think about any of this before the whole situation occurred, but being a Monday morning quarterback, sitting in my armchair at home and looking at what happened, I mean, it's clear to me that Russia was well prepared for what was going to be thrown at them. And it's kind of clear to me that the U.S. didn't. It seems like unless there's ulterior motives for what they're doing and why they're doing it, it seems like they didn't really game plan this to the extent that they needed to game plan it before they. It seems like they were sort of more like fire ready aim as opposed to, countering what Russia's doing with a well thought out game plan.
No, when it comes to the US dollar, we touched on this last time that it seems like this is speeding up the move away from the US dollar, especially with Russia talking about possibly introducing gold or commodities into their monetary system. Did you want to give us an update on this, how this might impact dollar hegemony?
Well, the dollar situation itself is not necessarily just versus the ruble per se. I mean, the ruble's not even in the US dollar index. So if you want to just measure the ruble versus the dollar, yeah, the ruble's outperformed the dollar by a considerable amount recently. In fact, I believe the ruble dollar relationship is now above where it was before anyone ever thought Russia might invade Ukraine. But so really what you're seeing with the dollar index is the dollar being measured against the euro, the yen, the British pound, the Swedish krona, and the Swiss franc. I think those are the 5 currencies that are in the dollar index. And that's just because right now the US, well, part of the reason is because the US is sort of raising rates and the rest of those countries really aren't. So there's that. I mean, we know Japan isn't, and I think the UK might have hiked their overnight bank lending rate, but I don't know. I can't recall seeing that the EU has raised rates yet. So just from that standpoint, that makes the dollar slightly more attractive relative to the other currencies that are in the dollar index. And the other thing that's going on is, well, there's a flight to safety aspect. I mean, the dollar is still, considered, it's kind of a knee-jerk flight to safety. I wouldn't call it an asset, but for lack of a better word, it's a flight to safety vehicle when you have a lot of turmoil. And there's a lot of turmoil, obviously, in the stock market, and there's a lot of turmoil that doesn't get discussed as much in the credit markets. Probably even worse in the credit markets right now. So, and then there's the issue of, just because of all the various, foreign issued bonds that are denominated in dollars, currency swaps, derivatives, and also the fact that the central banks, the Western central banks, especially the Fed, own a significant portion of the collateral that would have been used for various fancy central bank lending programs like the repo facility or whatever. There's a shortage of collateral. And so companies and sovereigns that have issued dollar denominated bonds, they're naturally short the dollar. And when they need to service that debt, they have to service it in dollars. They have to exchange their currency for dollars. So that puts further upward pressure on the dollar versus the alternative fiat currencies. And so that's kind of what's going on. It's not a sign of economic strength in the US that the dollar is rising versus the 5 other currencies, Western currencies that are in the dollar index.
Where do you see the dollar heading from here? Because, I mean, as you mentioned, it's not really a sign. The recent rally we've been seeing in the dollar is not a sign of dollar strength. And it does seem like we are seeing continued movements away from the dollar.
the dollar moving up the way it's moving up is more of a sign of the stress in the global financial system and economic systems. And, at some point, it's that stress is going to cause something to collapse. It depends on how you think this is going to play out. I mean, I think eventually if the Fed wants to avoid throwing this country into the worst depression in the history of the country, at some point it's going to have to start printing money again. And notice it has not removed any liquidity from the financial system yet. Its balance sheet is just as large as it was before it started rattling its chains about quantitative tightening, or removing the printed money out of the banking system, the banking reserve system. So the Fed's not even there yet on quantitative tightening. I think I don't know if they're going to start that or not, but if they do start that, the markets are going to crash even more. And the economies, I believe we're already in a recession, and the economy is going to get even worse. So at some point, unless it wants to throw this country into a devastating depression, it's going to have to reverse its monetary policies. Basically, the Fed is painted into a corner, and it doesn't have any good choices at this point. So, but history tells us that when countries are painted into a corner like this, then they just continue to devalue the currency, aka print money. And so I think that's where I see this playing out, unless, again, there's ulterior motives for why they might want to crash the system. But, I don't want to jump into the conspiracy theories.
Right. And when it comes to the recession you see we're headed into, or even in right now, you have been talking a lot about the housing market recently, and it does seem like we're kind of topping there. Can you expand on that?
Oh, I think the bottom's starting to fall out. And, I don't know if you saw the housing market data today. Now, the housing starts and permits, to me, that's more of a soft indicator. And they were down. Permits were down a lot. But mortgage applications, which are they're reported weekly by the Mortgage Bankers Association, and it's lagged by a week, or maybe a little less than a week. But purchase mortgage applications, which have been trending lower anyway, and part of that had to do with low inventory, part of it. But I would argue that most of it has had to do with affordability and the housing price bubble. Mortgage purchase applications were down 11% last week. So, that's just huge. And interestingly, I was just on Zillow this morning, just seeing what was going on in my area, because in my area, there really hadn't been a lot of houses on the market for at least a couple of years. And I was on there last week also. And the difference between last week and this week in terms of the number of listings was quite shocking. And there were also some houses that had what I would argue were listed at unrealistically high prices, but have had some pretty steep price cuts already. So, and this, I want to bring up my area because Colorado's been a hot market. It's been getting, people pouring in here from California, the Midwest, and the Northeast. And my area specifically has been really hot. And there's, up until recently, houses would trade by annual calendar appointment. So, and based on what I've been reading about other hot areas, it's starting to slow down. Now that, there's still probably some pockets where it's still flamed up with, it's bubblicious and hot, but, generally countrywide, all the data that I look at, and I look at it weekly, I scrutinize the data weekly because I incorporate shorting the housing sector into my short sellers journal. So the data that I've been looking at for a couple months has shown there's been a general downward trend in the housing market. So, and then I think we're going to see the super hot areas start to go next.
Now, when it comes to how this will affect the general economy, I know in 2008, this had a huge impact. It reverberated through the whole economy. How do you see if we do see a housing crash, that impacting the general economy here in the US?
I mean, all the factors that were in place and that led to what happened in 2008, those same factors are still, they're still there. The Fed never fixed the root of the problems, the sources of the problems. All the Fed did was paper it over by printing money. I mean, that was the first thing Bernanke did. I think they actually agreed to start printing money. I don't remember when they first started printing money or started their quantitative easing. But I think they had agreed to start doing it maybe in October of 2008, October or November. I may be off by a couple months, but and they printed a lot of money. And then we saw the same thing in March 2020. Now the economy, housing market, and the stock market were heading south back then before anyone knew what coronavirus was. So, and I was writing about it in my newsletter. I saw it in the data starting back in 2018, but for sure in 2019, because remember, the Fed actually started printing money in September 2019, and that was in response to the credit markets and the banking system were on the cusp of seizing up. Well, for sure, the stock market peaked, I think, in November or December of 2019, but it really started heading south in February. And there might have been some coronavirus element to it at that point. But at any rate, the Fed had started printing money under the guise of temporary repo programs, which became non-temporary and much larger very quickly, if you recall. So there were issues then, and it's those issues that were around in 2008 that were never fixed. And then in March 2020, all of a sudden, what happened gave them an excuse to dump $3 trillion into the system all at once, which is what they did. If you remember, they nearly doubled their balance sheet overnight, and then they continued their $120 billion a month thing. So, I guess my point here is that the problems have been festering since well before 2008. They were never addressed. They may not be packaged in the same gift wrap and ribbons as they were in 2008, but it's basically the same source of the problems. It's excess money printing. It's reckless government spending. It's artificially low interest rates. I mean, this is basically an artificial economy, and it has been for a long time. And they've had to keep printing money to keep the wheels in motion. And I mean, they can print money again, but I even said, I've been saying for a long time, if they're going to keep printing money, they're going to have to keep printing money at an increasing rate. And so far, the evidence shows that view is correct. I mean, at the end of the QE program that started in 2008, the Fed's balance sheet, I think, peaked around 4.3 trillion, something like that. And then, now it's almost at 9 trillion. So, and it doubled in a period of, and more than doubled, because they had worked off some of the balance sheet before they started printing again. It doubled, more than doubled in the space of less than 2 years. Whereas back then, it went from 800 billion to 4 trillion and change over many, several years, I guess, probably 6 or 7 years. So they're going to have to, if they want to keep things going, they're going to have to print a lot more money and a lot more quickly. And obviously that'll create hyperinflation. So I don't know what they're going to do. It's not going to be pleasant for any of us, though, regardless of how this plays out.
Now, there are analysts that I speak to who are seeing if there is going to be a recession going forward, or if we're going to see a continued stock market crash or housing crash, that precious metals would fall along with those other sectors. Your take on that? Because we have seen quite a bit of a downturn in the precious metals in the last couple of months.
We've seen a downturn in the price as expressed in the paper derivatives precious metals price. There hasn't been any large-scale physical selling of gold or silver. There's been, coin dealers sell gold and silver on a daily basis to retail buyers, and banks, the bullion banks broker bullion from major gold bullion producers into the countries that are buying them: India, Russia, China, etc. But there hasn't, correct me if I'm wrong, but I have not heard of any entity that owns a large amount of gold come out and say, we got to sell 100 tons of gold, bid, wanted, and comp. I have not heard that. There's very, very little wholesale physical gold has changed hands from buyers to sellers, other than from, producers who sell the bullion that ends up in the Eastern Hemisphere. So what you're seeing going on is in the derivatives market. And part of it is it's correlated with the stock market, because hedge funds, when they're the primary buyers of COMEX gold futures, just off the top of my head, they're probably, I don't know, if you look at the non-commercial side of the Commitment of Traders report, hedge funds are probably 80% of the long positions. So, and when they sell, in a market like we have right now, when hedge funds are dumping, they dump everything, because they're levered up and they need to avoid margin calls. And so one of the things they do is they dump paper gold contracts, because it's liquid. There's a market for it. The big banks are short those contracts. They've shorted those contracts into the hedge funds. Big banks are glad to take them off their hands, so because they book profits on it. So that's what we've seen in the gold and silver market is all the action's been in the paper derivative market. I guarantee you, if China announced that it was looking for 500 tons of gold all in one shot, it would take forever to produce that amount. And the way I would do it if I were them, just to see where the real market is, hey, offer, wanted, and comp on 500 tons of gold. Name your price, and we'll pay it, and that'll tell you where the real physical gold market should be trading. At some point, there's going to be a flight to safety rush into gold and silver, and it'll probably be all forms of it: SLV, GLD, COMEX gold futures, silver futures, LBMA forwards. You're going to see a flight to safety. We saw that in 2008, and we saw that in March 2020. Precious metal sector started heading north quickly about a week in advance of the stock market. And the only reason the stock market started heading north is because the Fed promised to print money and take interest rates back to zero. So that's why I would disagree with people who say, well, a recession and higher interest rates and a crashing stock market are going to cause the precious metal sector to go down. Yeah, it will, and it could for a while longer. I don't know, but at some point there will be that rush to gold and silver as wealth preservation assets, and the mining stocks will follow shortly thereafter.
All right. Well, Dave, we really appreciate your time today. Before we let you go, did you want to share with the viewers any last thoughts you had and where our viewers can find you online?
I would just say, don't fall into the trap of, buy the dip here in the stock market. This is a bear market, and it hasn't been acknowledged yet. And, a lot of people think that this is just washing out some excess speculation. This is a bear market. Inflation is destroying the profit margins of corporations. We saw that with Walmart yesterday and Target today. And those are the big guns. Walmart's one of the largest companies in the country, in the world, and its stock was down something like 10% yesterday, and it's down. I'm not even sure. It's down 5%, another 5% when I looked, and it's going to get worse. And Target was down 24% today. So that just tells you that there's still way too many people who own stocks, way too many institutions, and this is going to get a lot worse. And I don't know what's going to turn it around and fix it. The tech bubble took 2.5 years before it bottomed. And the 2008 market crash would have taken a lot longer if the Fed didn't start printing the amount of money that it started printing. So I would say don't fall into the trap of listening to the experts who say, oh, stocks are cheap here. They're not. They're going to get a lot cheaper, and earnings estimates are going to come down quickly. And also, if you're scared or worried about the precious metal sector, honestly, and I hate using the cleanest shirt or the least dirty shirt in the laundry. I hate that analogy, but gold and silver, that's it. I don't know if it's going to continue to go lower for a while, but you're going to be much better off if you put your money right now into physical gold and silver, and maybe just start nibbling away at your favorite mining stocks. So my website is investmentresearchdynamics.com, and you can get more. I post blogs, not as much as I would like to, but I try to post some blog posts. Sometimes it's content from my newsletters. I share content with my newsletters, and then there's links there where you can find out more about my mining stock journal and my short sellers journal.
All right. Once again, Dave, thank you so much for your time, and God bless.
Thanks for having me, Elijah.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.